Welcome to First Mover, your first global look at today's action in the Bitcoin, blockchain, and digital asset space. I'm Michael Casey, filling in all this week for Christine Lee. Joining me are my co-host, CoinDesk Managing Editor of Global Capital Markets, Lawrence Lewitinn, and Managing Director of International Content, Emily Parker. Hello to you both.
Hey, Michael, how are you?
Very well. Okay, it's made it to Friday. I've made it through the week. Let's take a look to start with at the Bitcoin price. The Coindesk Bitcoin price, XBX index, is trading at 33,007 cents. That's up 1.24% on the day. And the Bitcoin Ether price, ETX index, is at 2,111.71 cents, down 2.25%. So you wouldn't know it looking at crypto prices right now, but we're seeing some bold moves to drive the industry forward, not least of which is Circle's decision to go public. Circle is, of course, best known for issuing the USDC stablecoin, a digital token that's intended to retain a stable value, in this case, 1-to-1 with the dollar. Emily, what do you make of this announcement?
It means that the era of stablecoins is officially here. We're going to see a lot more of this going forward. The race is on between central bank digital currencies and these sort of more private dollar-backed stablecoins. So I think this is a sign of a really important trend happening in cryptocurrency.
Lawrence, thoughts?
This, of course, you said dollar-backed stable coins, but the thing about stable coins that we're finding is that there are assets that are actually backing it, not just the US dollar. And I think that kind of transparency that Circle is promising going forward, that's going to be an important part of this conversation, because if stable coins are going to play a role in a world where you have central bank digital currencies, for instance, people want to know whether or not their dollar or their stable coin is in fact a dollar as it's stated. So that's where we are right now with this.
Well, let's actually see if we can get some details on this straight from the horse's mouth. Circle CEO Jeremy Allaire joins us now to discuss. Welcome, Jeremy.
Thank you, Michael. Great to be here.
All right, well, it's great to have you. Look, amongst the information that came out yesterday, there was an investor deck you shared, and there was a lot of details in it, one of which was a slide that essentially showed the total addressable market as the entire $130 trillion in total money in circulation. That's a pretty bold idea. Can you lay out the vision and how Circle going public feeds into this?
Absolutely. I mean, look, over the past decades, we've lived with a fiat currency system that's built on fractional reserve commercial bank lending, and when you have a dollar in a bank account, it's actually it's in this fractional reserve money as the M2 money supply, and that is commercial bank electronic money. So that is a privately issued electronic money operating within commercial banks. Globally, that's about $130 trillion, which is incredible. I think our premise, and Michael, you've known me since the earliest days of founding Circle. My premise is that more and more value will operate in digital currencies. There's an inherent approach, whether it be the scarcity model of a Bitcoin or the full reserve model of a stable coin. There's a benefit of full reserve dollar digital currencies. And we believe that as these programmable digital dollar instruments exist on these public blockchains, as the efficiency and utility value of those explodes, that yes, more and more businesses, corporations, other financial institutions, fintechs, and obviously individuals around the world are going to want to hold and use these digital currencies as a primary means of exchange and settlement. And just like the internet itself slowly took percentages of the long distance telephone call business, the amount of textual content being published versus in print, this is going to be a gradual process of a migration of money from M2 type money into digital currency money, and we think that is the target market, and you can choose your time frame and how quickly that kind of change happens, but we think it is that large.
Jeremy, welcome back to the show. It seems that the main competitors, so to speak, to stablecoins are not actually Bitcoin or Ethereum. It's more like central bank digital currencies, right? Which are, also pegged to more stable forms of fiat. So last time you were on the show, you said that the US does not necessarily need a central bank digital currency. I guess my question is like, do you think that stablecoins will end up serving that role? I mean, is there a world in which like stablecoins and central bank digital currencies will coexist, or do you think one will eventually kind of overshadow the other?
Well, I mean, right now, we have open blockchains, public blockchains, and we have protocol development and private sector innovation happening on top of that. That is sort of a continuation of the open internet infrastructural model that has powered so many different industry transformations. And I think that is going to be the predominant model that transforms the global financial system. Now, obviously, as this grows and grows to scale, the relationship between the financial institutions that are operating potentially what could become systemically important financial market infrastructure, systemically important payment infrastructures, the relationship to central banks will evolve. You're going to need to imagine that the many firms that participate in those kinds of arrangements are going to have very strong relationships with central banks. And forms of charters that are appropriate to the scale of work that they're doing. So my expectation is, private sector innovation, open source, open internet innovation is going to lead us into a world of billions of people interacting with digital currency. And as that happens, absolutely, there's going to be a lot more work to do with central banks, including the Federal Reserve.
Hi, Jeremy. Welcome back. I think if you come on one more time, we get to stamp a card and you get a free latte. So always great to see you.
Great to see you.
I want to call up a tweet you tweeted out yesterday where you said, and I'm going to quote here, it says, as we partner with major companies and financial institutions, and as people around the world interact with USDC, becoming a public company is a critical step in providing greater transparency as a firm. So the question that people have been asking is this: what is to stop you from having that transparency now? Are there any legal limitations to that transparency? Because, my understanding is that there shouldn't be, or there isn't.
Yeah, I mean, the key thing here is, as you can probably tell, we've been in a very, very extensive process for many, many months preparing for this transaction and the imminent public disclosures that come along with it. And so what I also communicated yesterday was that our intention is, as part of beginning to provide these public filings that'll be available to the world, be available to the SEC, et cetera, we are looking to add that level of visibility. So these are financial statements, and these are reviewed by our auditors, and they're reviewed by the SEC. So that's the appropriate venue and medium to publish and share that kind of information versus just off the cuff remarks I might make on,
Do you think that it'll happen sometime? Do you think it'll happen sometime? I guess it's around November or so, is given the way in which you structured the SPAC.
No. So what I've said is that so Circle, alongside Concord, the SPAC, are required to file a Form S-4 with the SEC, which it's like an S-1, but for a combination transaction such as this. And that's an extremely comprehensive set of materials and disclosure on the company. And our intention is to include greater reserve transparency there. And that's critical. It's critical because we are building a public institution that a lot of people are building on and depending on. And it's one of the other side effects, as I noted, of becoming a public company in this space, I think it really demonstrates rigor that's needed to operate a global financial institution building this kind of technology.
So, Jeremy, that debate about, the transparency, the issue with regards to, disclosures regarding reserve holdings and so forth, feeds into something of a debate about the regulatory framework for stablecoins. We heard, on the one hand, Boston Fed President Eric Rosengren make a case for his concerns about, the risk of instability that stablecoins might pose, presumably worried about, breaking the buck and the idea that, the stability of the thing may not be so clear, and that should be more heavily regulated. On the other hand, Randall Quarles, one of the Federal Reserve voting governors, said, look, stablecoins gives us this chance to innovate. We should probably do less with CBDCs and focus more on stablecoins, instead of implying more of an open approach to this. Where do you see this playing out, and what sort of conversations are you having with regulators about this?
I mean, look, there's a lot of pieces to that. I mean, I think the first thing is, the United States has had a very regulatory around electronic stored value payment infrastructure, and I don't think that Eric is saying the tens of billions of dollars of balances held with PayPal represent a systemic threat, or that all the money held by Stripe or Square or Apple Pay or others that are huge and are defining consumer scale fintechs in electronic stored value payments infrastructure. I don't know that the same questions are raised there. So I think we believe, though, that stablecoins are different, right? This is a different innovation. It's a more powerful innovation than these closed loop, walled garden proprietary types of systems of the past. I think it's one that does deserve a greater degree of transparency, and that's why when we constructed Center Consortium and worked on this with Coinbase and built governance models and other models, we went above and beyond what would be needed. So that will continue, and I think it's very likely that we'll see adjustments to various forms of bankings and payments regulations around the world in major countries to adapt to some of the nuances and unique characteristics of stablecoins, and we welcome that. It's critical if we're going to end up helping build the critical infrastructure for how the financial system works, how financial market infrastructure works, how businesses conduct commerce on the internet at scale. That's totally appropriate. And we look forward to the dialogue and the engagement and the partnership with national governments all around the world.
So, Jeremy, Representative Warren Davidson was on here a few days ago, and he said that depending on what an asset a stablecoin has, it should be regulated as a security potentially because it's too similar to, say, an open-end fund. He said that one of the things that might happen should the taxonomy bill that they're proposing right now in Congress pass is exactly that kind of clarity. If that happens, should USDC, what would keep USDC from becoming regulated as essentially a security? And also, should stablecoins, other stablecoins, face that scrutiny as well? I
mean, look, as you know, the design surface for stablecoin innovation is really broad. Right now, there's an enormous amount of experimentation. Various bond crypto collateralized forms of stablecoins where you're trying to generate pegged value from market mechanisms and incentive designs. That's a huge area there. I think regulators will take a look at that and say, what is instruments? I think digital currencies, dollar digital currencies like USDC are very clearly fit into this electronic stored value payment instrument model that has worked for decades of innovation in digital payments. So I think there is a good framework there. However, I do think that as these reach kind of larger scale than maybe legacy payment systems have, there will very likely need to be different rules. What those are remain to be seen. I don't have an expectation that there's going to be laws swept through Congress that are going to change this. This is going to be something that requires a lot with agencies with finance ministries, with central banks, with supranational bodies that are looking at this and trying to harmonize and normalize this kind of work, the FSB example, around the world. So it's not, a congressperson says this is what it should be. This is something that needs to be considered and thought through broadly, consistently, and globally, because this technology is a highly global technology just by its.
Jeremy, speaking of global technologies, one of the biggest, most important developments in the digital currency space is China's development of a central bank digital currency. And I would just be curious to hear your take on how big a deal is this, right? Because I think opinions vary on this. Some people are like, oh, this is going to really change everything. This is going to threaten the dollar's position as the global reserve currency. And other people are like, it's not that big a deal. People are just, kind of getting a little bit too worked up about it. Where do you fall on that spectrum? How important is China's central bank digital currency, and what tangible impact could it have on the US dollar and just the world?
Well, I think, in my view, the role of the Chinese yuan in international trade isn't so much going to be influenced by whether or not there's a digital payment system run by the Chinese government. It's going to have to do with broader economic relationships that are deep at the country level, at the trade corridor level, and frankly, the primary thing is the opening up of Chinese capital markets and the opening up of the Chinese currency and the capital account. Those are the things that are really going to impact its use more globally. Having a digital payment technology to interact with the banking and settlement system of China is certainly important, but I think those other factors are far, far more important. In terms of the ECNY project, I think you have to put it in a different context, and I've shared in other forums, which is there's a very large response in China right now to the rising power of private companies. And you see this in a lot of ways in recent days, even. And I think when you look at the motivation for ECNY, it's really a motivation to have an e-money alternative to Alipay and WeChat Pay. That in some ways those were powerful. 1 billion people depending on a private e-money. I think that there needed to be a kind of third way. And that was something that could be supported by the state-owned enterprise banks. And I think that's really been the primary motivation, as opposed to some kind of plot to undermine the dollar globally. If anything, the Chinese are interested in not necessarily the Chinese yuan becoming the global reserve currency, but really establishing a synthetic global currency based on something like the SDR, which is something that since 2009
those are all
have advocated.
Yeah, those are all really good points, especially the part about the convertibility of the Chinese currency. But I guess it's not so much about China's secret plan to take over the world. It's more about the more central bank digital currencies there are, the higher the probability that you can have these cross-border transactions that don't need the US dollar or SWIFT for settlement, right? So I guess looking at it that way, could that could that world order threaten the supremacy of the US
Well,
dollar?
I think this goes the other way. Today, dollar digital currencies can transact globally without touching SWIFT. And other digital currencies like Bitcoin can transact globally without touching SWIFT. And so internet native money is a profound innovation. It's an innovation that is not just about stable coins or CBDCs. It's internet native money. It's here. It's growing rapidly and will continue to grow. And that's something that the world has to adjust to. That's something that countries have to adjust to. A world where basically individuals in the countries can kind of vote with their smartphone what economic system they want to participate in. And I think it's a relatively level playing field. One of my colleagues, Dante Disparte, had a recent piece that he published and really spoke to, I think, some of these points, which is that, the United States is actually winning the digital currency space race right now. its private industry has established technologies out in the open in the free market that are already widely available and can transact around the world. So I think the question is the United States going to try and out China, or is it going to really support the growing innovation that's coming out of the open internet, open blockchain, and private sector space?
So, Jeremy, speaking of China, what about Binance? What happens to your business as Binance finds itself in more and more regulatory issues all over the world? What happens to USDC and your projections?
Yeah, I mean, I don't really look at a specific correlation there. USDC is widely used globally. It's widely used across many exchanges, digital wallets, DeFi projects. It's the most widely adopted, dollar digital currency in DeFi. There's just so much activity happening in so many different use cases that are utilizing this technology. It's not tied to, say, one centralized exchange. And so I look at just overall the growth in adoption of public blockchains, the growth in the utility value of dollar digital currencies like USDC, and the continued significant expansion of use cases. I'm excited about when major internet brands begin adopting things like USDC, or consumer-facing fintechs and others start connecting to these networks, as opposed to just looking in the rearview mirror at just the Bitcoin trading exchanges.
All right, Jeremy, that's all we have time for. Thank you so much for your time. That was Jeremy Allaire of Circle.
Thank you.
Coming up, Nicholas Merton with markets analysis and stories from the YouTube crypto community.
CoinDesk Indexes, the market standard for crypto assets since 2014. Our trusted data powers billions in publicly traded funds. CoinDesk Indexes are the standard used by institutions, and they're the key for investors looking to understand and access crypto markets.
As the company that launched the world's first ever Bitcoin ETF, we at Purpose chose the CoinDesk Bitcoin Price Index, the XBX, to price our assets.
CoinDesk Indexes enabled the early adopters to build crypto investment vehicles, and they're already trusted by a new generation of global investors.
Time now for the daily forecast, an update on what's happening in the Asian crypto markets. Here's Justin Solomon of Forecast News.
Welcome to the Daily Forecast, July 9th, 2021. I'm Justin Solomon of Forecast News, covering all things blockchain, filling in for Editor-in-Chief, Angie Lau. Coming up, could the Delta variant spook crypto markets? Thailand's central bank issues a warning against crypto payments, and a third major bank in South Korea enters the nation's crypto custody roster. Let's get you up to speed from Asia to the world. The worrying rise in numbers of COVID Delta variant cases around the world could put the global economic reopening into reverse. Just this week, a newly issued state of emergency in Tokyo has led to a ban on any spectators at Olympic events that are set to take place in the city beginning on July 23rd. It's also resulted in traditional markets taking a dive as investors worry about the impact on global growth. But could that caution hit crypto markets next? If so, we could see a rise in Bitcoin dominance as investors move towards assets they deem safer havens. One analyst told Forecast News that may already be happening.
Bitcoin dominance had been edging lower for the past week or so, and then it kind of bounced back up, walking back on 2 days of losses. That essentially signals people are transitioning from alts and towards Bitcoin.
And while some investors may be thinking twice about the investment potential of digital assets, it seems that crypto as a payment tool is gaining steam. But that's getting more authorities around the Asia-Pacific region worried. Thailand's central bank is the latest to issue a warning against the use of digital assets for payments. But just last week, Forecast News reported that Thailand-headquartered luxury hotel group Pavilion Hotels and Resorts had made moves to accept crypto for payments. Now the Bank of Thailand has issued a statement reiterating that digital assets are not legal tender. The bank has also warned that both parties involved in any crypto transaction face the risk of price volatility, cyber theft, and money laundering. The statement goes on to say that if digital assets gain widespread use, the bank will coordinate with the country's Securities and Exchange Commission in order to take measures to ensure crypto does not pose extensive risks to the public or financial system. And taking a quick look at the market now, Bitcoin closing up nearly 1.25% to end the day just shy of $32,900 US. That's as of 4 p.m. Hong Kong time. And in the top 10 for cryptocurrencies, a mixed day across the board. Ethereum taking the biggest hit though, down 2.7% at the end of Asian trading hours here in Hong Kong. Finally today, one of South Korea's 5 major banks, NH Nonghyep, is branching out into digital asset custody and NFTs. The bank signed an MOU with digital payment service Galaxia Moneytree, credit card value-added network service KICC, and blockchain developer Hexlent to develop a digital asset custody service. The joint effort will focus on developing digital asset custody with Hexlent's blockchain-based wallet. NH is the 3rd major Korean bank to jump into crypto custody after KB Kookmin and Shinhan Bank took the lead earlier this year. NH is also developing a way to link users to NFTs and security token offerings, which is a public offering of tokenized digital securities. This is something that neither of its banking peers in crypto custody has tried yet. So what can we look forward to in the future of banking? Professor Park Sung-jun of Dongguk University Blockchain Research Center explains.
현재 금융 세파에서는 금융권들이 일반 소비자에게 줄 수 있는 상품은 한정이 돼 있습니다. 사실 크게 몇 개 없습니다. 일반인들이 참여할 수 있는. 근데 이게 디파이가 된다면은 블록체인 기반으로 창출되는 디파이 서비스는 제가 볼 때는 무궁무진하다고 보거든요.
NH is not only one of the largest banks in Korea, but also one of the few that support crypto exchanges. The bank backs BitThumb and Coin1 by providing real name bank accounts for their users. This banking partnership is one of the major requirements that enables exchanges to apply for a license with local authorities. Those that are unable to woo banks such as NH will be forced to shut down following the September 24th deadline. And that's the daily forecast from our vantage point right here in Asia. For more, visit forecast.news. I'm Justin Solomon of Forecast News. Until next time.
The Crypto Markets Update is presented by Grayscale, the world's largest digital currency asset manager.
Checking in on Bitcoin again, the Coindesk Bitcoin price XBX index is at 33,176.55 cents. That's up 1.77% on the day. And the Coindesk Ether price ETX index 2,136.69 cents. That's down 6.9% on the day. So if you've been looking at the crypto blockchain rabbit hole for as long as I have, you may have come across our next guest. He has nearly 500,000 subscribers on YouTube, and his videos providing analysis of cryptocurrencies have received more than 35 million views. I'm talking about Nicholas Merton, CEO and producer of the Data Dash YouTube channel. He's also the CEO of a new app called Digifox. Nicholas joins us now to discuss the crypto markets and the very active YouTube crypto community, his app, and more. Welcome, Nicholas.
Michael, Emily, Lawrence, thank you guys for having me. It's a pleasure.
Hey. So you got some charts for us, Nicholas, to take a look at. Why don't we call up the first one?
Yeah, for sure. So I wanted to spend some time here to kind of put a premise or understanding of where we are within the market now, because I think there's been this consistent debate where you're either on one end or the other of, oh, we're in a bear market or correction. It really is one way or the other. So I wanted to spend some time to talk about the recent correction that we saw and compare it to previous historical price. And this one focuses on the more exaggerated sell-off or correction that we've seen this time around, and why I'm making the case that. Oh yeah. Mm-hmm.
When you talk about exaggerated sell-off corrections and rallies, is that because of leverage?
Yes, I'm actually going to build on that. That's a great point. Yeah. Basically,
okay.
What you're what you're seeing here, it's a very good point. So if you take a look at the chart here, we have basically 3 major market cycle kind of rallies we're analyzing, as well as the following corrections. They're just mid-cycle corrections. So these aren't, for example, the bear markets where you have the full peak top of the market and then correct down a full 80%. And one of the reasons that I wanted to bring up this chart here is because if we analyze these three mid-cycle rallies and corrections, you can see that over time, in this case, we're expecting lower returns on the upside. And then outside of that as well, we should be expecting, at least to the broader analysis, most people, the typical 30-40% corrections, because most people are analyzing 2017. When in reality, what's really interesting about this chart is that as time progresses, usually each cycle takes longer. And what we saw here between the 2017 consolidation rally, the first actual rally from the lows, which took over, in this case, we're looking at a 2-week chart. So well over 70 weeks here in this case to actually complete and go up around 370%. In this previous rally from the lows of back in December 2018, we were able to do this in less than half the time period, around 30 weeks, and we pretty much rallied the same exact percentage amount. So to your point, actually, in this case, Lawrence, like what we're seeing here is these exaggerated rallies and then also exaggerated corrections due to increased leverage trading in the market with the abundance of lending platforms where you can borrow stablecoin credit and increase your exposure to the crypto market, or borrow digital assets and sell them, effectively short selling the market. What we're seeing is exaggerated short squeezes on the upside from people trying to short the market, which is dragging prices higher. And then outside of that as well, we're seeing a lot of longs getting liquidated and basically these platforms having to sell the underlying crypto collateral.
Let's move into your second chart here, Nicholas. Let's check we are running short on time. So let's look at the second chart here.
Yeah. So the second chart here is talking about the expanding cycle theory, from basically taking a look from top to bottom in the market. It tends to be that from bottom to top, we have expanding cycles over time. And what's interesting is that if this really is a bear market, if this is the market top that people are so confident of in claiming that it's a full-on bear market, we're going against history quite severely here. We not only were shorter than the previous cycle here, but it tends to be that every single cycle expands around 11 to 13 months from the previous one. You can kind of see this here as we're taking a look at the monthly chart here. So as we continue to go through these expansions, we can see very clearly that this time around we had a shorter cycle than the last one. And this would definitely go against the historical norm that we've seen.
Okay, and a third chart. I think Emily has a question on that.
Yeah, the third chart. So my understanding of the third chart is you're basically saying whether this is a bear market or a correction, it doesn't really matter, right? Why is that?
Yeah, so I mean, unless your time preference, that's actually a great question there, Emily. Like, unless like you as an investor, if your time preference is maybe a week or month, perhaps maybe the S&P 500 might be a better investment than Bitcoin or gold might be a better investment. But if you're looking at the longer term time frame, if you're really just looking to expose yourself to one of these three different assets on the chart here, where we're comparing Bitcoin, the S&P 500, and gold, really over the last decade, you can see here whether you're taking a look at a 10-year time frame or a general annualized return, Bitcoin overwhelmingly outpaces these assets. It could be even that we're in the middle of a bear market at the beginning stages, and we go full through another 30, 40, 50% correction in price. But still, in the next year or two, you're still going to be outpacing the S&P 500 and other assets.
Thanks so much for that, Nicholas. That was Nicholas Mertens of DataDash and DigiFox. Coming up, we talk to the CEO of Abra, Bill Barhydt.
The Coindesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
How do these interest rates sound to you? 8% on your savings, 0% on a loan. Sounds too good to be true? Well, these are in fact the kind of rates we're seeing from a growing number of crypto lending and borrowing platforms seeking to disrupt the banking industry. And there are many questions about this. So joining us with some of the answers is Bill Barhydt, CEO of Abra. Hey, Bill.
Morning.
So, Bill, I've been covering you for many years, and I've noticed multiple iterations in Abra's business model, from remittances to a sort of a synthetic investing play, and now these interest-earning borrowing and lending kind of structures. Can you explain what this latest model is all about?
Sure. I mean, it's an evolution for us of offering a full crypto banking suite. We offer people the ability through our brokerage to trade, now to earn high yield through their dollar stablecoin and crypto deposits, and also to borrow against crypto holdings, which is a super fast growing part of our business, so that people can basically borrow without having to recognize capital gains to avoid taxes in the short term, or to continue to reap gains while they access some of the winnings on their crypto holdings.
So, Bill, how do you guys get yourselves that 8% return to pay out that as interest? And how are you offering leverage to others, or what exactly are you guys doing to get that and also provide low cost loans?
Yeah, so we generate yield in three ways, and you have to keep in mind that there's a yield curve in crypto which is very different than what we associate with the banking system, because these are transactions which are traditionally so far not part of the banking system, because when the banks hear the word crypto, they tend to head for the hills, and then the consumer is left on their own, or the institution is left on their own. So that represents kind of a different yield curve here. So we're generating that yield in three different ways today. The first is consumer lending, and there we will often take collateral from the consumer, which could be anywhere from 2 to 10x. You mentioned our zero interest loan, which would basically require up to 10x collateral, but is a very, very safe environment, right, for generating that yield. Then we have a certain amount of DeFi investing that we do. We've been very, very conservative in that area, but it's been growing at a reasonable clip now, and it's generating great returns for us. And the last, of course, is institutional lending, which has been our bread and butter since the beginning, from the beginning of the company. But this has been a great winner for us. And all in, I mean, we're actually paying about 85% of the returns to our depositors, consumers mostly, and some institutions that are now also generating that 8% yield on dollars and 4 to 5% on crypto.
You have a very ambitious global strategy. You're all over the world. Which countries are you seeing, or which countries or regions are you seeing the most activity? And are there any surprises in the global data, like places where you're seeing things that you wouldn't have expected?
Yeah, so I think that we have a really interesting kind of two target customers that we're seeing en masse come into ABBA right now. Very, very high net worth customers, and that's in multiple countries, who love the narrative of crypto, believe that it's their hedge for their wealth protection, and love the idea of generating yield and potentially borrowing against those holdings. Then we have an emerging markets, right? So places like the Philippines, which I've talked about here before, now Central America, we're live in El Salvador and Guatemala, and more countries coming soon, Middle East, India, places where the narrative is slightly different, but actually overlapping with that high net worth narrative, which is that I've seen my currency in my home country go to shit one or multiple times. I don't trust necessarily my local fiat currency. I love the idea of being able to store money in dollars and get exposure to Bitcoin. Very similar to the high net worth narrative, but coming at it from a different perspective. And our belief is that they're going to meet in the middle over time and become kind of a global middle class system. But for now, we're seeing the biggest adoption at the two edges, in the high net worth and the developing markets.
Thank you, Bill. Unfortunately, that's all we have time for. That was Bill Barheit of Abra. That's it for First Mover. Thank you, Emily Parker, our Coindesk Managing Director of International Content, and Lawrence Lewitinn, Managing Editor of Global Capital Markets. I'm Michael Casey. I'll be back live at 3 p.m. with All About Bitcoin. Coming up at noon is The Hash. You're watching Coindesk TV. Bye for now.